Hey guys, so this video is being recorded to help explain that MBS are actually bonds, mortgage-backed securities are actually bonds, and how they're securitized, what securitization is. MBS are the bonds that mortgage loans are turned into when they're bought or sold on the secondary markets. The secondary markets are Fannie Mae, Freddie Mac, and various investors, including the Federal Reserve, that buy these MBS or bonds, mortgage-backed securities, on the secondary markets on Wall Street after the loans are closed and the mortgages are pooled together, called pools, which I explain a little bit more about that in some of my other videos if you got to catch that. So essentially, a big bank will write a check for your mortgage. Say it's $100,000. Big Bank A then has a promissory note saying you will pay them a certain interest rate over time. But Big Bank A needs some more money to lend to other people. So where do they get it? They can sell your mortgage to someone else in the form of a bond, mortgage-backed securities that we discuss in greater detail in some of the other videos. Hopefully, the investor is willing to pay something like $102,000 for the right to collect the interest that they're going to earn on your $100,000 loan. Big Bank A just made $2,000, and the investor has something that will hopefully pay them interest over time. Remember price versus yield. If you caught my other video on mortgage-backed securities, we went into a little more explanation about the price of mortgage-backed securities versus the yield. Well, the higher your interest rate, the more the investor would be willing to pay Big Bank A. So when you're looking at mortgage-backed securities, typically the higher the rate, the more that mortgage-backed security is going to cost on any given day. That's what we actually call yield spread. And if the investor is only going to pay $97,000 for the loan, for example, that means Big Bank A has to pay them a discount to buy it. So they're gonna charge that back to the client. So I can show you here on this chart here. So these are the mortgage-backed securities. So you're going to see the different coupons, and I was just talking about yield versus price. So we have the yield, which is a fixed amount of return that they pay for these bonds or mortgage-backed securities that buy in increments of $100, and they're each as the yield increases on these bonds, so does the price. The price goes up that the investor has to pay, or the bank who originally did the loan, whatever bank's going to buy that loan from them as a security, has to pay higher amount for a better yield, which is ultimately equates to a higher interest rate. Now, here's a good example. So on the 4.5 coupon, which is what we call these are called, the yield is called coupon or issuance. So on the 4.5 coupon, on September 20th, it was underneath par or 100. So if I'm Big Bank A and I want to sell that loan to Big Bank B, they are only going to pay me $97.34 for every $100 of that loan. So they're going to get it at a discount. So if I was basing my rates on September 20th, so I'm coming out, I'm the lender, I'm going to come out with my rate sheet. I'm going to have to charge points or a higher interest rate that pays me more points to come up to 100 to bring this back to par. So that's how lenders set their rate sheets every day, and that's actually how mortgage bonds dictate the mortgage markets, which we'll get into a little more in depth on another video about how MBS impacts rates. But I want to help explain why there may be points on a loan until you get up to par, which you can see the 5.5 ticket on September 22nd. It's actually above par, so there's some yield spread there, and that's what they're talking about when they say YSP. And also what has to happen opposite of that is when there's no YSP, there's points involved because the lender has to bring it back to par, and then they have to make their money to actually, they have to make a profit. Or me as a direct lender, I have to make a profit. So I'm going to put some more into the rate or into the points to recover whatever the investors are not going to pay in the mortgage-backed securities once this hits the secondary market. So it's all a chain reaction, and that's why mortgage-backed securities are the best indicator to watch for mortgage interest rates on a daily basis. So we kind of touched on this a little bit, but the investor doesn't want all of their risk on one loan. So we have to find a way to spread out the risk because we got to keep moving this money around for liquidity purposes. So even if you only have a 3% chance of default, in the event that you did, the investor would lose everything they invested. So to spread that risk out, Big Bank A combines your loan with tens or hundreds, really thousands of similar loans with similar rates and similar credit quality. So that was the mortgage-backed security. So we may have, my company may combine multiple loans on the 5.5 coupon. Now they can be at different rates based on this price. As the price goes up and down, we're going to charge more or less points, or we're going to have a higher interest rate, but it's attached to this coupon, this rate, this bond, mortgage-backed security rate of return. And this is what the investors are paying us to free up our money. So we're lending from our lines of credit, and then we're selling these loans after they're closed, about 30 days after they're closed, to the secondary markets and getting money back to free up more to keep on lending. So that's what we're talking about here. And we want to mitigate the risk to the investor by selling them a bunch, even at discounted rates sometimes, where maybe our margins are very thin because it's a lower coupon. Maybe it's one of these coupons here, 3.5, 4, 4.5. There's not as many to get investors to buy that. We're going to have to, because the return's not as great, we're going to have to reduce the price. So we're losing some money in some cases, a lot of times. So what it says here, Big Bank A combines your loan with tens or hundreds of other similar loans with similar rates, similar credit quality, as I said. Then either by selling them directly to Fannie Mae and Freddie Mac, the agencies, secondary markets, or by utilizing the Fannie and Freddie protocols and doing it ourselves, which our company does. We actually securitize our own loans and sell them on Wall Street to the investors directly, which again, sometimes that could be the Federal Reserve, for example, but it's also individual investors on Wall Street. Big Bank A has accomplished what's known as securitization. So we're talking about securitizing. What that does is it allows us to sometimes dictate our own prices for second homes or investment properties and do some really neat stuff that some other companies can't often. So now the pool collective of all the bundled loans, which we've already discussed pools, I discussed them in greater detail in some of the other videos, would now be in the millions of dollars and can be broken up into bond-sized chunks. And that's where the MBS securities come into play. So now instead of buying one loan for $100,000, give or take, an investor can buy a portion of tens to hundreds, really thousands of loans for the same amount of money with the same rate of return, like I showed you the coupons. And that has allowed a significant larger amount of money to be available for home loans than ever before. So this didn't used to be around with the secondary markets, used to just be the banks. You had to put 20% down. But now that mortgages are turned into bonds and resold in the secondary markets, or sold in the secondary markets from us as a direct lender or bank, after we make the loan with our own funds, then it gets sold and frees up more money, giving us more liquidity, and the circle gets completed over and over again. So we're constantly moving money around, churning money essentially to lend more, and then it's based upon whatever coupon and mortgage for the mortgage-backed security that's popular at the time. Right now, today, for example, it's really the 5.5 coupon. You can see here the 5 or 5.5 because it's almost at par. This is at par or above par. So that's going to be less points and more attractive, although we have to raise the interest rates to meet that threshold. So I hope this helped explain a little bit more about how MBS, mortgage-backed securities, are bonds, and the securitization process and why lenders do it to give themselves more free up funds and give more liquidity to keep our economy going, essentially. Please reach out with any questions anytime. Thanks again.